Hello and welcome to this video on the topic of donor-advised funds. I'm Kaleb, the founder of 10 Talents Financial Planning, and I likely sent you this video because you are a 10 Talents client and you already do some charitable giving. I really love that you're doing charitable giving, and I want to teach you how to use a donor-advised fund to give more tax efficiently and to have some other features as well in the donor advised fund that you may not have available currently. I use a donor advised fund. My wife and I use it for our charitable giving. I'm very familiar with them, and I thought I would do this video to help you understand them better. They're incredibly powerful, but what I recognized was having some material can be helpful to visualize. So I'll be sharing my whiteboard screen and I will be giving you illustrations. And I hope that this helps you see the value and how we can harness the power of donor advised funds to just do the giving that you're already doing, but do it better. A lot of the work I do with clients is optimization. We're cranking up the dial on optimization and efficiency and just taking what you're already doing and making it better. So it's a lot of fun. Let's dive into this. I'm going to share my screen here, but let's actually, before I do that, one comment. Let's just talk about how taxes work on giving. You may have had a Boy Scout come to your door, maybe pre-COVID, or someone says, give to our foundation. It's tax deductible. What these people don't say is they don't actually know if it's going to be tax deductible for you. They just mean that you're giving to a 501c3 nonprofit charity that is eligible for a tax deduction. To be clear, currently we're in 2021, filing taxes for 2020. The standard deduction, whether you do charitable giving, whether you own a home and have mortgage interest, whether you have a job and pay state income taxes, whether you pay property taxes on that home that you have the mortgage that you own, regardless of any of those, all of those that I just said are itemized deductions, as well as healthcare expenses could also be in there and some other random smaller ones. To be clear, you only deduct those expenses if you exceed the standard deduction. Right now, for a married couple, $24,800 is the standard deduction. So let's set the table first of all. If you have state income taxes and property taxes, that's $10,000 or more, you get capped at $10,000. That's called the SALT cap, state and local tax cap. And that was with the Tax Cuts and Jobs Act that started in 2018. So there's $10,000 that many people have as a deduction or an itemized deduction just because you have state income tax, you work in a job, and also have property tax if you own your home. Then let's say you have $10,000 of mortgage interest. Now we're up to $20,000. And let's say you did $4,000 of charitable giving. Well, guess what? That mortgage interest, no benefit to you. Property tax, no benefit to you tax-wise. That $4,000 of charitable giving, no benefit to you. Why? Because the standard deduction was $24,800, and all those things I just said added up to $24,000. So you need to understand this just from the get-go. Once you turn 65, that standard deduction goes higher. So you'll be getting close to, depending on how old you are now, if you're heading into retirement, not quite 65, you'll be hurtling towards 28, 29, 30,000 of standard deduction. So regardless of how much giving you do, regardless of whether you have a mortgage or don't, you're going to get almost $30,000 ages 65 and older for married couples if you take the standard deduction. And so we need to be aware of this because many people think they're getting a tax deduction for charitable giving, mortgage interest, etc., but you don't. So we're going to talk today about how the donor advised fund can flip the script and help you to itemize. So let's take a look here. I'm also going to turn off my video just to minimize movement on the screen. So here we go. All right. Donor advised fund. So here's how this works. You're going to have something that you donate into the donor advised fund. You have to put something in here. So what we're going to do is we're going to look over here and we could say cash is something we could look at. Cash is an idea, but we would prefer not to do cash if we don't have to. The other would be appreciated securities. Okay, we could say stocks, funds, mutual funds. Stocks, mutual funds, something that's appreciated in value. And we'll talk about why in just a second. You're going to take these items and you're going to put them into your donor advised fund. Now, where would you do this? You would do this at Charles Schwab. You would do this at Fidelity or Vanguard. I have mine at Charles Schwab. I have clients that have them at Fidelity. I have clients that have them at Vanguard. Vanguard has very high minimums. Schwab and Fidelity do not. So you put the cash or the stocks into the donor advised fund. You receive, let's just say we're in 2021, you receive the tax deduction in 2021. Now, this is the power of the donor advised fund, because let's say you have a highly appreciated stock. And for the purpose of this argument, we're going to say that the value of that stock is $20,000, okay, with appreciation. The basis of that stock, the basis is important. We're going to say that the basis, we're going to say this is a highly appreciated position. So highly appreciated means basis of 2K. We're going to call this basis. So you've owned this for a long time and it's increased in value from 2,000 up to 20,000. You're then going to put the $20,000 of stock right here. You're going to stick that into the donor advised fund. Now you say, why would I do that? I only give $4,000 a year. All right, watch this. You receive a tax deduction for the full $20,000 in the year you make the contribution. Now, do you remember earlier I said you were giving $4,000 a year, but receiving no tax benefit? If you do $20,000 of giving into your donor advised fund through this highly appreciated stock or cash, whatever it may be, you receive a $20,000 itemized deduction in the year, ding, 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 in the year that you make the contribution. So remember how I said 4,000 is not cutting it in terms of charitable giving. In my example, we had 20,000 of itemized deductions because of mortgage interest, etc. What if we added 20,000 to that? Now you have $40,000 of itemized deductions. Can you deduct that on your tax return? Yes, you can. You can now take a $40,000 itemized deduction in, you guessed it, 2021. You see the power of this. Once the money is in there, you get the deduction. You get it in the year that you make the contribution. So that spread between the standard deduction of 24,000, we'll put it over here, 24,800, and this 40,000 here at the bottom, that delta, that is the tax benefit. If you are watching this at home, you can do the quick math here. Let's say you're in the 24% federal tax bracket. We just created over $3,600 of tax savings if you're in the 24% bracket. If you're in a higher tax bracket, let's say you are in the 33% tax bracket, we just saved you over $5,000, just federal, by structuring your giving differently. Now you might say, Caleb, well, wait a minute. I don't want to give $20,000. You just told me I had to put $20,000 into this donor advised fund, right? Isn't that what you just said? And that is what I just said here in the donor advised fund. Here's the deal. You do not have to give charities the full $20,000 in 2021. You are able to do what's called make grants. So we put money out of the donor advised fund. These are called grants. You make grants in small increments. They could be $50. They could be $100. This is your monthly giving. This is your one-time giving. This is your quarterly giving. You make these grants at any time in the future. So you have control of when the charities get the money. Now watch this. You put $20,000 over here, right, of stock. But you told me, Kaleb, I only do $4,000 a year of giving. Okay, then you just front loaded 5 years of giving. 4,000 times 5 is 20. If you put 20,000 in here, you receive the deduction. Here's that $40,000 deduction down here, 20 plus 20 in our example. That is much higher than 24,800 standard deduction. You get the tax deduction in that year, and you can grant it out any time in the future. Are you starting to see the power? But wait, there's more, and there is more. When you put the 20,000, let's go back here. When you put this $20,000 right here, when you put the 20,000 into this donor advised fund, we said that that was a highly appreciated stock. That highly appreciated stock, you got a tax savings there. And the tax savings was, look down here. See how I said it has 2,000 of basis? If you would have sold this, let's jump out here on the little space I have left. You would have paid $18,000. Oh boy. 18,000 of capital gains taxes. So if you would have had to pay tax on $18,000 to give this to a charity, guess what? The charity's not getting $20,000, right? They're going to get a fraction of that because you have to pay tax on that amount. So let's take taxes. Rough estimate on taxes, it's going to depend on your tax bracket, the state you live in. That's another $4,000 to $5,000 of tax savings on the capital gains. You are not having to pay taxes. Cross this out. No capital gains taxes on that appreciation from 2K to 20K that would have been taxed at short-term or long-term capital gains. So we've got a lot of advantages here. To recap, you've got the itemized deduction over here in the bottom right-hand corner. Donor advised funds allow you to bunch or to gather your charitable giving into select years. We don't do this every year. We could, but we don't, because the next year in 2022, right? So let me put my little arrow here. In 2022, are we going to do this? Not if you give $4,000 a year. In 2022, you're just going to go back to the standard deduction of $24,800. The only difference is you're not doing $4,000 of cash giving. You're not going to do $4,000 of cash giving because you've got your donor advised fund. You've got 20 grand sitting in here in the DAF. That does your giving. You're not doing your giving out of cash. Now you can, of course, you can give cash. You can, buy a homeless person a sandwich. You can do that, but your primary giving to 501c3s will come out of the donor advised fund. I've totally filled up the screen here. So hopefully this was helpful for you as we discuss this. You will likely have questions. So I'm going to come back on the video here. We'll turn off the screen share. Thank you for watching this video. I hope it's been helpful. Donor advised funds are incredibly powerful. If you saw some of the numbers on there, I've gone much higher with clients. I've done 50,000, 100,000, multi 6-digit numbers. The power of the donor advised fund only gets magnified the bigger the numbers get. So in terms of taxation, in terms of selling a business, having a highly appreciated stock, and we also want to do this before retirement. That's a separate video, but we need to be doing this before retirement so that, spoiler alert, you can be doing most of your charitable giving out of your donor advised fund in retirement if possible. Thanks again for watching. I'm really glad that we were able to spend this time together, and shoot me an email with questions that you may have, or we can of course follow up in our next meeting and discuss further. Thanks again, and I hope you have a great rest of your day.